First question, decision making, make or buy. A manufacturer produces hacksaw blades. Recently, the manufacturer had decided to enhance its product line and offer band blades. This is what they are making. This is what they want to make. Two alternatives are being analyzed: purchase band blades overseas. Either they can purchase it from other country or they can make them in-house. If the band blades are made in-house, manufacturer will not be able to produce hacksaw blades. If they make this, they cannot make this. Foregoing a $30,000 profit contribution, so they have to lose this. Okay, like opportunity cost. Revenue from sale of band blades, outside purchase, direct material and labor, variable manufacturing overhead, avoidable fixed manufacturing overhead. That means this is like something which they can avoid. And they're asking calculate the incremental cost of making and purchasing band blades respectively. Just a second. Now, calculate the incremental cost of making and purchasing band blades respectively. So like how much is the cost they are going to incur if they make and if they are going to purchase. Fine. These are the four options given. Once read this question, we'll do this. Shall we do? Yeah.
Yes, yes.
So the incremental cost of making and purchasing bandwidths. So first we will go for making. So what is that they are going to, if they are going to make this, what is that they're going to incur? Of course, direct material and labor, variable manufacturing overheads. Okay.
Okay.
Avoidable fixed manufacturing overhead. This is avoidable. Fine. But
Yeah,
if
right.
they are going to make, they are going to incur this, right? Whatever
Yes.
the cost they are going to incur, we are taking.
Okay.
Direct material, direct labor, variable manufacturing overhead, avoidable fixed manufacturing overhead, and then the foregone contribution of 30,000. This is also they want to recover. Am I right?
Yes.
It's their lost income, which is also like a cost and important for decision making. So how much is that?
1,90,000.
Yeah, and for outside purchase, just
Mm,
1 lakh 70.
170. Okay.
This is the option. Okay,
Okay.
move forward.
Yes.
Company accepted a contract to provide 30,000 units of product A and 20,000 units of product B. Company accepted a contract to provide this much units of product and this much units of product B. The company staff developed the following information with regard to meeting this contract. So what is the company's staff is doing? They are taking some information with regard to meeting this contract. So they are seeing product A and product B, selling price for both the products, variable cost, fixed overhead, machine hours required for making both, machine hours available. What they have is this much. This is the constraint they have, right? This much only they have. Fixed overhead is given. Cost if outsource. If they outsource per unit, how much is going to cost them? This much. The operations manager has identified the following alternatives. Which alternative should be recommended to management? They're asking, make 30,000 units, 20,000 units, 25,000 units, rent additional capacity of 30,000 machine hours, which will increase fixed cost by 150. We will take all 4 alternatives and see which is giving us the highest income. The one which is giving us the highest income is what we are going to pick. Okay.
Okay. Yeah.
So
Yes.
here we're like, okay, I'm doing it here. Some part here, some part here. So 30,000 units, 25,000 units. So we are going to take the cost, the list of the cost. Rent additional capacity. So these are units, right?
Yes.
So now let's say company accepted a contract of 30,000 of product and 20,000 of product B.
Yes.
Yeah, so what they're asking is 30,000 of product A, 20,000 of product A, 25,000 of product A, remaining capacity to make product B. That means if they are making, and like just a second. Accepted a contract to provide 30,000 units of product and 20,000 units of product B. So 50,000 they can make, it seems. Make 30,000 of A, utilize the remaining capacity to make product B and outsource the remainder. Okay. So if only they make 30,000 and remaining they make B and outsource operation. Make 20,000, utilize remaining to make B and outsource the remaining 25,000. Okay, okay, fine. Fine. So we are very much concerned here. Make 30,000 units, utilize the remaining capacity to make product B and outsource the remainder. Fine.
Okay.
So every cost is very clearly given. So sale of product A, if they make 30,000, what is the selling price?
75.
Just multiply. Because in every option, first they are making A only.
Yes, sir.
Yeah. So
22
30,000,
lakhs 50,000.
22 lakh 50,000. And if they make 25,000, then
18 lakhs 75,000.
just
Hello.
yeah, just a second.
Okay.
$20,000 of product A. Okay, first we'll see the first alternative. Sale of B. Just a second. Like multiply 20,000 with 125.
125. 25 lakhs.
Yeah. Because if they make 30,000 of A, the remaining they can make 20,000 of
B.
B, correct? Na? So they are
Yes, sir.
making 30,000 of A. When they are making 30,000 of A, they can make 20,000 of B. So 20,000
B.
into 125 is 25 lakhs, correct?
25 lakhs. Yes, sir.
Yeah. And if they are making 25,000 of A here, no, they are making 20,000 of A, right?
Yes, sir.
So 20,000 into 75 is how much?
15 lakhs.
15 lakhs. Just a second. 25. They're making 20,000 of E. So we will see we will see every option. 30,000, 25,000, 20,000. Okay. Okay, fine. If they're making 30,000, so 20,000 goes for B, right? So what is the total sales here? If we add this,
47 lakhs 50,000.
then variable cost, sales minus variable cost, and then like all the costs we're going to remove. Okay, and from sales we're going to see the net income what we're getting. Variable cost
30 into
30.
30,000.
Yeah, variable cost of A. So I think 99 lakhs.
9 lakhs.
Yeah, for B.
48 into 20,000, sir.
Yeah,
9 lakhs 60,000.
no,
96.
just a second.
48.
Just a second. Just a second.
Okay.
Variable cost of B. They are giving 672. What is this 672 all about? Just a second. Yeah. Hello.
Yes, sir.
Just multiply 125 into 25,000.
31 lakhs 25,000.
Okay, see, if they're making 30,000 of product and utilize the remaining capacity to make product C, B and outsource the remainder, I don't understand. 30,000 units of product A, 20,000 of product B. What kind of calculation? Variable cost for product A we have taken, that's all right. This particular statement what they have given, make 30,000 units of product A. Okay. Utilize the remaining capacity to make product B. 30,000 already they have accepted to make A and 20,000 of B.
Okay.
And here if I take this, if I'm making 30,000, utilize remaining capacity to make product B and outsource the remainder, what are we going to do? If I take 30,000, 30,000 into 48 is how much?
14 lakhs 40,000.
14 lakhs.
40,000.
14 lakhs 40,000. I just don't get this. Just a second. They're giving 672. If I take 6,72,000, if I divide with 48, I get 14,000. I don't understand how that 14,000 is coming. So is it 30,000 they are making and 14,000 for product B and
6,000.
6,000 they're outsourcing? Nothing like is very clear in this. Purchase cost is given. Purchase cost is not at all given. Is purchase cost given to us?
No, sir, only hours. Available hours they have given fixed.
That's what I'm saying. And that too they're making. So what is the, how come I can say purchase from where? What is the, they are saying 3,60,000 for purchase of B.
How?
Where is the purchase
How
price
they
given?
get,
Sorry?
yeah. Yes, sir, how they are getting 6,30,000?
No, which 6 lakh 30? No, the purchase price is not given. Nothing is given. That's what I'm saying. The
Yeah, only
data
selling price
selling
and
price
the
is given, and the information is not at all there. Like if they are making this much, then remaining. I really don't understand about this question. What the problem is? 30,000 they want to make, utilize remaining capacity to make product B, like outsource the remainder. Sales of A, B we have taken, total sales we got, variable cost of A and B. So for 30,000 units also we should get variable cost of B, right? But
yes.
they are, it's like they are writing 6,72,000 on what basis? Just divide 6,72,000 by 30,000
6,72,000.
by 30,000.
22.4 I'm getting, sir.
How is that possible? How is that we are getting? Okay, we will see afterwards. This I'll check it.
Okay.
I'll clarify. Yeah, this question. Let's go for the next one. A manufacturing company is considering a new product for the coming year, which requires the production of an electric motor. Company can purchase the motor from a reliable vendor for this much. They can buy this. Such kind of cost is also not given in the previous question. Or
Yes.
manufacture it internally. Either they can buy or they can make. Company has excess capacity to manufacture this much motors needed in the coming year, except for manufacturing space and special machinery. That means they have capacity to make, but they don't have space and also special machinery for that. Machinery can be leased for this much annually. Company has finished goods warehouse space that it currently leases for this much, which can be converted and used to manufacture motors. To replace the finished goods warehouse, additional offsite space can be leased at an annual cost of this much. So these are all expenses they're going to incur. Estimated unit cost for manufacturing the motors internally, exclusive of leasing cost itemized above are given below. If they manufacture, what is the cost? You leave the leasing part, fine.
Okay.
So we will see what is the cost. Direct material,
Okay.
direct labor, variable manufacturing overhead, and allocated fixed manufacturing overhead. Should the company make or buy the electric motors and why? What they should do. So for if they make the product, what are the costs? $8 plus $4 plus $3. Okay.
Okay.
These are the variable expenses, correct?
Yes, sir.
These are relevant costs.
Okay.
If they make this product in-house, fixed cost is irrelevant.
Irrelevant. Yes.
Why irrelevant? Whether they make it or they don't make it, they have to pay
Pay
this.
the same. Yeah.
In the previous question, this was avoidable fixed manufacturing overhead. Okay. And here
Okay.
what is given to us? Allocated fixed manufacturing overhead. That means that is that kind of expenditure we can easily, that is what they have given the flexibility for us to use. That means we that much fixed manufacturing overhead is allowed to us. That means they have allocated for that process.
Okay.
Here it was avoidable. Avoidable means it is relevant for decision making, right?
Yeah.
It is upon us. Either we can kind of if we want to try, we need not incur this. It's upon us. If we want to use and
Hmm.
incur the manufacturing overhead, we will. Otherwise, we will not.
Okay. This is irrelevant. Okay.
Yeah. So there it is irrelevant. Why? Because it doesn't matter whether you are making or not. This is you're going to
Pay the
definitely
same.
incur. Yeah. So now we got $15. Now, how many units? They are saying us to make 30,000 motors, right?
Hmm.
30,000 motors, isn't it so?
Yes, sir.
Yeah,
Notice.
30,000 into 15 is how much? 4,50,000.
3,000.
Now,
Correct.
should the company make or buy the electric motors and why? So if they make, they are going to incur 4,50,000.
3,000. Yes.
See, to make this, these are the costs related to material, labor, manufacturing overhead, and manufacturing overhead.
Yes.
But they want machinery also to make, right? So for that, they have to lease the machinery.
Yes.
So that lease, they are going to incur how much money for that? Machinery can be leased for
40.
45,000 annually.
Yes.
And
Is the warehouse.
they have to lease the warehouse also.
Yes. 39,000.
Yeah, they see the company has finished goods warehouse. Just just a second, sorry. Just a second. Yeah. So 45,000, the machinery can be leased for 45,000 annually, right?
Yes.
And company has finished goods warehouse space that it currently
Yes.
leases. That means they have leased it, which can be converted and used to manufacture the motors. To replace the finished goods warehouse, additional offsite space can be leased. That means they want to take one more space, right? For that, they
Yes.
are going to incur 54,000. So how much is it going to be? Nine.
5,49,000.
Sorry,
5,49,000.
5,49,000. Okay. This is what if they
Mm.
manufacture.
Yeah.
If they manufacture, right?
Yeah.
And if
Yes.
they're going to buy 30,000 into 21, how much they're going to incur for buying?
6,30,000.
If they buy, they have to incur this much cost. If they
Mm.
manufacture, they have to incur this
Mm.
much. You tell
Yes.
me how much they are saving. If they make, it is costing them less, right? And they're
Yes, sir.
saving how much? 81,000.
81,000. Yes, 81,000.
Yeah, this was a pretty easy question. Please make a note of this. The previous question I don't understand. There's no head, no tail. I will see that question.
Okay. Sir.
Purchase cost is not given. Purchase is
Mm.
not given. Nothing is given. They just gave selling price. They gave variable cost, fixed overhead. When it's a make or buy question, they have to give the purchase price, right?
Yes, sir. Only they have given produce
Yeah.
make
The company
variable
can
cost.
purchase the motor that they have clearly given the purchase price. There are no data about the purchase price. Only for outsourcing they have given.
Yes. Done, sir.
Okay. We will do fifth and sixth question first, then we'll go for this.
Okay.
Yeah, fifth question you need to answer. Cost relevant to an insourcing versus outsourcing decision rule. Decision include variable manufacturing cost as well as dash. They are saying cost relevant to an insourcing. That means whether you want to make, okay, or you
Okay.
want to get it from
Fine.
outside, or you want to give it to someone, some other party for making this product. See,
Okay.
what is outsourcing? A lot of work from America is given to Indians to do, right? So they are
Yes.
getting it done from
Oh,
outside source,
right.
and insourcing is doing it from our own
Uh,
sources,
Yes.
and that includes variable manufacturing cost as well. We have done in the first question
Yes. Avoidable fixed cost.
about our
Okay.
fixed cost.
It's
This is
really
very
good.
relevant in
Yes.
case of insourcing versus outsourcing decision.
Okay. Sir.
Sixth question.
Company currently manufacturing component. Still manufacturing.
Company currently manufactures all component parts used in manufacture of various hand tools. Yeah, a handle is used in 3 different tools. Unit cost budget for 20,000 handles is direct material is given, labor is given, overhead is given, variable and fixed overhead is given, total unit cost is given. A parts manufacturer is offered to supply 20,000 handles to the company for this, each delivered. If the company currently has idle capacity that cannot be used, accepting the offer will. So what they're saying is a parts manufacturer is offered to supply 20,000 handles to company. See, there are two things here. Company currently manufactures all component parts used in manufacture of various hand tools. Handle is used in 3 different tools. Unit cost budget for, they have given the budget, the cost budget, how much it's going to cost you. So what is relevant for you if I take everything only variable,
Direct
right?
material.
Yeah.
0.60.
0.60 plus 0.40 plus 0.10, or only variable cost is relevant for us. Fine.
Yes. Yes, sir. 1.10. Okay.
Now, see, here parts manufacturers offer to supply 20,000 handles to company for some 1.25.
Each. Yes.
If company currently has idle capacity that cannot be used, accepting the offer will. See, if they have idle capacity, they can make this here, right?
Yes, sir.
So what happens when you have idle capacity? There is nothing to look for other alternatives. You can make it, right? Because you
Yes,
still
sir.
have idle capacity.
Yeah. Along with sales
Yeah.
production. Okay.
Otherwise, you have to look for other
So,
alternatives if you don't have idle capacity.
right.
Fine. So the existence of idle capacity indicates firm has no opportunity cost to be considered in the calculation. Opportunity cost comes only if you look for other alternatives. Isn't it so?
Yes, sir. Yes, we did
So
previous.
if you accept their offer, it's you see, if you have idle capacity, it is better to manufacture rather than take the offer, right?
Right.
Because if a manufacturer is going to cost you 1.10, and also you have good amount of capacity with you to make. If you
Right.
take this offer, you are going to pay how much extra? 15 cents,
Point one.
$0.15 per unit, right?
Right.
That is 1.25 minus 1.10.
Right. 1.1.15.
Yeah, so increase the handle cost by 0.15. Shall we move forward?
Yes, sir.
Yeah.
Understood.
Can you do this? Can you try this,
Yes,
Samri? We will
okay, sir.
discuss and then we'll go back to that question. Big one. Yeah.
Scroll up, scroll down.
Give me a second. I'll be back.
Okay. Sir.
Yeah. So let's do this, Samri.
Yes, sir.
Let's discuss first. Listed below are company's monthly unit costs to manufacture and market a particular product. So the per unit cost what they're going to incur is manufacturing cost, direct material, labor, variable, indirect, fixed, indirect, marketing cost, variable, fixed. Company must decide to continue making the product or buy it from outside supplier. Supplier has offered to make the product at the same level of quality that company can make it. Fixed marketing cost would be unaffected. They have however they have to pay.
Yes.
But variable marketing cost will be reduced by 30% if they take this offer, right?
Okay.
So we have to see the question in such a way that how much they are going to save if company were to accept the proposal. What is the maximum amount per unit that company can pay the supplier without decreasing operating income? That means if it is better for if they accept the proposal, how much they are saving, we have to see, right?
Yes, sir.
So if at all they are buying from outside supplier, what costs they can avoid?
Mm.
So what cost they can avoid here? Direct material they need not take, $2, right?
Yes, direct labor.
Direct labor they need not pay for labor, $2.040.
Mm.
Variable overhead they need not incur. But what they said, variable marketing costs. Okay, we'll come to
Mm.
that. They are like variable, uh, like uh, variable indirect. What is that variable indirect overhead? 1.60. Are they
60.
going to save this? Yes.
Indirect. Yes.
Yeah, they are going to save this. And
Yes, sir.
marketing, fixed marketing cost would be unaffected, but
Would be
variable
reduced by
marketing cost would be reduced by 30%.
2.50.
So they can save how much of that 30%? 30% of 2.50 is
0.75.
that also they are going to save variable marketing cost. And 70% of the variable marketing cost they are going to incur, right?
Yes.
Is it so? Yes.
Right.
Do you think
Correct.
fixed cost is relevant for us?
No, sir.
No. If it is avoidable, then only we will check.
Yes.
And 70% of the cost they are going to incur, regardless of they make or don't make. Correct? Only
Right.
they are going to save 30%, right?
30%. Yes, sir. Yes.
70% they are going to incur if they make or they buy. So it is it relevant? It is not relevant.
Not relevant.
See,
Only we have to do
if you are
30.
taking, if you are accepting the proposal, then also you have to pay. If you are not, then also you have to pay.
Right.
Yeah. So what is the total?
6.75.
This much is what they are going to save. So what is the maximum amount per unit the company can pay the supplier without decreasing operating income? 6.75.
75.
So
Okay.
the firm will avoid the cost of 6.75 if they accept the proposal, right? So at least it will at least it has to break even by paying not more than 6.75. This is
Okay.
what they're going to avoid, right? If they go, yeah, if they're going to take the proposal.
Right. Yes, sir.
So the maximum amount per unit the company can pay supplier without decreasing. So this much they're ready to pay. More, because this much is what they're going to save if they're not going to
Right.
take the proposal.
Yeah.
Sorry,
Right.
sorry, not going to manufacture.
Make, sir. Right.
Yeah. See, 2.40, 1.60, 0.75. All this is if they accept the proposal, they're going to save this. That means if they're going to manufacture, they're going to incur all this. If they're not going to manufacture, they're going to save this. So this much is minimum what they will be always ready to pay to the supplier, right?
Yes, sir. They are
That's
saving
what.
this.
So they don't want more than this. What they can save there, they don't want more than that to pay. See, if for making I'm incurring $10,000 and for buying I'm incurring $12,000, it is better to make, right? So if
Yes, sir.
at
They are
all the
saving
supplier
30.
is able to give me a better deal and if I'm going to get less than this, then only I'm going to go with the supplier.
Yes.
So all those costs what I'm going to incur to make the product, okay, that
Okay.
much I'm always ready. But if better deal I get from the supplier, I'm going to go with supplier. So
Right.
these costs, if I can save, okay, I will always be better off to like restrict my supplier to extent of this much. That means this much, however I'm going to save. This is what is the maximum cost I am ready to pay to supplier. Are you understanding?
Yes. Yes, sir. Yes, got it.
Yeah, break it for
This
the
will
break even.
save.
Yeah.
Okay.
Next question.
A company's approach to outsourcing outsourced decision.
Company's approach to insourcing versus outsourcing depends on whether company is operating at or below normal value, whether operations are at normal or less than, or is less important than amount of idle capacity. The company is less likely to buy if it has sufficient unused capacity. Correct?
Yes.
In the
In
first,
about
the first particular option, companies approach to either making or giving it to someone
outsourcing.
else, the opportunity to make or buying from some other source depends on whether company is operating at or below normal value. See, whether operations are at normal volume, okay, that is less important than the amount of idle capacity. The company is less likely to buy if it has sufficient unused capacity. Correct? If company has capacity, if company can make 5,000 units,
Okay.
and if company has utilized 2,500 units and
Mm.
they still have 2,500 units,
Yes.
they can make 5,000 units, right? They have already
Right.
made 2,500 units and they still have capacity for making more 2,500 units. What will
Yes.
they do? They can use this idle capacity, isn't it so?
Yes, and they can use.
What is normal volume? 5,000 is normal for them. So whether
Mm.
operations are at normal volume is less important than amount of idle capacity. Company is less likely to buy if it has sufficient unused capacity, correct?
We can insource
They
only.
can in-source, yes.
Yes.
This is very relevant. What we have already discussed
Yes.
involves an analysis of avoidable costs, what we can avoid. Should use activity-based costing. What is this? Activity-based costing is used to allocate fixed overhead. Fixed overhead is not relevant in insourcing outsourcing decision unless it is avoidable. So in
Yes.
activity-based costing, what you do? You allocate fixed overhead. What do you do?
Allocate fixed overheads.
That means what is allocation? A particular for a particular task, this much particular fixed expenses I'm going to incur. Okay, that
Right.
means this is department A, this is department B. So I have $50,000 with me. 30,000 I've allocated for department A's rent, and 20,000 I've allocated for department B's rent. That is allocation. What belongs? What is like uh, to be like allocated, or what particular expenditure belongs to which department has to be spent for that department. That is called allocation. So we have just
Yes.
divided the amount in that way. So
Uh,
in activity based costing that happens, they allocate fixed overhead, but fixed overhead is not a relevant thing for us
Yes.
unless it is avoidable, right?
Avoidable.
Now
Okay.
absorption costing, we take all the cost, but we don't take all the cost, right? Always fixed cost is not
Relevant.
relevant for us. Yeah.
Yes.
So we can do this. Please go for this fact. Yeah. So let's discuss this. Richardson Motors uses 10 units of part number T305 each month in the production of large diesel engines. Okay. They use 10 units of part number this. Somebody not following? Hello?
Yes, sir. Yes, sir.
Yeah, yeah. The cost to manufacture 1 unit of T305 is presented as follows. So it requires this much of direct materials handling, 20% of direct metal cost. That means whatever the materials handling cost you are incurring, that is 20% of this.
Okay.
Labor, manufacturing overhead is 150% of direct labor. Direct labor based direct labor. Yeah, this one is just given. And total manufacturing cost is in front of you. Material handling, which is not included in the manufacturing overhead, represents the direct variable cost of receiving the department that are applied to direct metals and purchase components on the basis of their cost. It's not a part of manufacturing overhead. They have not taken that in the manufacturing overhead, but that represents the direct variable cost of receiving the receiving department that are applied to direct materials. That means they are working, they have some involvement in direct material, but they have purchased some components on basis of their cost. Okay,
Okay.
that means their involvement is there in the purchase of
Great.
raw materials and some components. Richardson's annual manufacturing overhead budget is 1/3 variable and 2/3 fixed. And Simpson Castings, one of the Richardson's reliable vendors, has offered to supply T305 at a unit price of 30,000.
30.
So we have been given all the information regarding making and also regarding buying.
Fine.
Assume the rental opportunity does not exist, and Richardson Motors could use the idle capacity to manufacture another product that could contribute this much per month contribution. If Richardson chooses to manufacture 10 of this in order to maintain quality control, Richardson's opportunity cost is. So we have to see the alternatives here, correct?
Okay.
So we will see the better opportunities what we are going to take up.
Yeah.
So first we will see how much they are going to incur if they make. So total manufacturing cost minus the fixed overhead. Fine. What is that going to give us?
Make.
Because we are not going to take the fixed overhead. It is not relevant for us. So we are going to take
Yes.
only the manufacturing cost. So what we are going to take?
Direct
So
material.
directly, so they have not given per unit cost, right? They have directly given us the total manufacturing cost. So total manufacturing cost. Now,
Yes.
then we are going to take this is manufacturing overhead. What they have given.
1/3 is variable.
Yeah, that's what I'm saying. So Richardson's annual manufacturing overhead budget is 1/3 variable and 2/3 fixed. So we are going to remove the 2/3 of this, right?
Third. Yes.
Because we want only variable part.
Variables.
Less fixed cost. So that is 24,000 into 2/3. How much is that, Samri?
16,000.
What is the answer here?
26,400 is variable.
Yeah. So this is the relevant cost for us. Okay.
Okay.
Now, this is the manufacturing cost. Now, if they are going for purchase, 30,000 they have to incur, right?
Yes.
And apart from that, anything else they have to incur?
No.
So, it represents direct variable cost of, yeah, materials handling, which is not included in the manufacturing overhead, represents the direct variable cost of the receiving department that are applied to direct metals and purchase components on the basis of their cost. So here it is like we are like cost of component, right? What we are going to purchase.
Yes.
See, materials handling, which is not included in the manufacturing overhead, represents direct variable cost of receiving department that are applied to direct metals and purchase components on the basis of their cost. So then we have to take that this like 20% of the cost, right? See, 20% of the direct metal cost.
Yes.
Metal
Yes.
handling is always on the basis of 20% of
Material, direct material cost.
direct metal cost. So this is variable receiving cost because clearly things are mentioned. Material handling, which is not a part of manufacturing overhead, represents the direct variable cost of receiving department, the ones which is going to receive,
Mm.
that are applied to direct materials and purchase components on the basis of their cost. So on the basis of this only the purchase cost they are going to incur. So
Yes.
per unit price is 30,000. Of that 20% goes for
Purchase cost.
material handling.
It,
That's what when they are purchasing some component, they're going to get additional cost of 20% of that. Correct?
okay. Yes. So 20%
Of the
from
purchase of the unit purchase price.
okay. That is material handling.
Yeah. Yes. Receiving department has to pay. So 36,000, correct?
Yes.
Now, so now if you are going to buy, it is going to increase your cost by how much?
36,000. 9,600.
Yeah. This is for 1 unit, right? This is what we have done for 1 unit of T305.
Oh, yes,
But
apart.
we are looking for how many units?
10.
10 units, right?
Yes.
10 into 9,600, 96,000. Now, so what they are saying is, assume that the rental opportunity does not exist. Richards and Motor could use the idle capacity to manufacture another product that could contribute this much per month. So if for 10 units additional cost of purchasing is 96,000, the net effect of purchasing is a gain. Why? See, assume the rental opportunity does not exist and
Okay.
Richardson Motors could use the idle capacity to manufacture another product that could contribute 1,04,000 per month. If
Okay.
Richardson chooses to manufacture the 10 units in order to maintain quality control, opportunity cost. If this is what is they can get, right? If they can use the idle capacity
Yes, they have per month. Okay.
for making some another product, correct or wrong?
Yes, a contribution.
If they are going to make another product, they are going to get this much. So what is the difference getting created? 8,000, correct? Opportunity cost of making the part. If they don't make this part and if they make another part, they're going to get how much?
36.
See, 1,04,000 they are getting to make another product, right? With the idle capacity what they have.
Yes.
And if they make this, they are incurring how much?
8,000.
No, 96,000.
For contribution, 1,40,000
See,
is the
for 10 units, the additional cost of purchasing is 96,000, right?
yes, sir.
So, like if they are going to purchase, the cost they are going to incur is 96,000.
Okay.
So opportunity cost is the benefit from the next best alternative use of the resources. Hence, company's opportunity cost of making the part is 8,000, right?
Yes.
1,04,000 contribution from making another product minus 96,000. This is the gain, correct or wrong?
Yes, sir. Right.
Yeah. So for 10 units, the additional cost of purchasing is 96,000. The net effect of purchasing is a gain of 8,000. Okay.
Okay.
Because what we have calculated, we have already got the differences.
Hmm.
If at all they are making
26,000.
26,400, if they
Yes.
buy one unit
36.
36, they are saving how much?
9,600.
For 10 units, they are saving how much?
96,000.
This is what they are saving for 10 units, right?
Yes, sir.
And 1,04,000 is what they are, assume rental opportunity does not exist. Richardson Motors could use the idle capacity to manufacture another product that could contribute this much per month. If
Yes.
Richardson chooses to manufacture 10 of this in order to maintain quality control, what's the opportunity cost? So this is what they're going to save and this is what they're going to get. So they have to look the better alternative, and the difference of this much is going to make them to decide what is a better alternative. Correct or wrong?
Yes. Yes, sir.
That is 8,000.
Okay.
Opportunity cost. Just do this. So first what we did is we have calculated the manufacturing cost, correct?
Yes.
That is the variable cost what we are going to incur to manufacture. That is 26,400. Then what we did, if we are going to purchase one component, it's going to cost us 36,000. So what is the out of the pocket cost would increase by 9,600 if the components are purchased, correct?
Right.
If
You're
we are
saving 96,000 by producing.
yeah, we are saving 9,600 by producing,
100.
and if we are buying, we are spending more for like buying. Okay, see, if we make,
Yes.
we are going
It's
to
saving.
incur 26,400. If we are going to buy, we are going to incur
30.
36,000. Definitely 9,600 more we are spending here, right?
Yes, sir.
So the cost is increasing by 9,600 for buying, and that is for 10 units, the cost is going to increase by 96,000.
96,000. Right.
So additional cost of purchasing this is.
Okay.
Now, like what they assume, the rental opportunity does not exist, and Richardson Motors could use the idle capacity to manufacture another product that would contribute them this much. Now we have to look whether we have to buy 10 components of this or make this. The decision is based upon the difference what is getting created. That is nothing but the opportunity cost, which is 8,000.
8,000.
Yeah, either we want to go for this or we want to go for using our idle capacity to manufacture this. The only decision making depends upon the difference.
Opportunity cost. Okay. Got it.
Shall we go for next one?
Yes, sir. Just a minute. And
The beneficiary thing is 1,04,000, right? That is better.
yes, that is more. Done.
Yeah. So if we make it, we are going to lose 8,000. If we don't make it, that means
They are
this
going to
particular
gain
96,000, yeah, 8,000 is the opportunity cost. Yeah, okay, this one. Somewhere. A table manufacturing company has the following cost structure for producing tabletops. Direct material, labor, variable manufacturing overhead, fixed manufacturing overhead, variable administrative cost, fixed administrative cost, total unit costs are given. Recently, table manufacturer received an offer from a corporation to supply the tabletops to the table. That means there are two things. They can manufacture, okay? If they are like producing the tabletops, the cost structure is given in front of us. And some manufacturer has given them some offer to supply tabletops, right? And the table manufacturer is considering buying the tabletops instead of manufacturing them internally. Which one of the following statements is correct? So we will only see the relevant cost here. Fine. If they manufacture, what is the relevant cost?
23 to 1.
How much?
45.
And administrative cost as well. Fixed administrative costs, however, they have to incur. Correct or wrong?
Yes.
because it is administrative cost. Whether they make it or they buy it, doesn't matter. So this much they want correct minimum.
47.
So the table manufacturer should accept the offer if it is less than 47 and the table manufacturer has excess manufacturing capacity.
Okay.
If the other person, see, the total unit cost like includes what? See, this fixed cost, is it avoidable fixed cost?
Yes.
Is it avoidable?
No, sir. No.
This is not avoidable. Is this
Yeah, it's
avoidable?
relevant.
This they are going to incur, right?
Yes.
So the total unit cost of 67 includes unavoidable fixed costs. Unavoidable. Unavoidable. So total cost includes 20 of fixed cost, which is unavoidable, right?
Right. Yes.
That means the total unit cost includes $20 of fixed cost that is not avoidable if the units are purchased. See, they are having some manufacturing is going on with them already. They are manufacturers, right? So for
Yes.
them, they are going to incur the manufacturing overhead that is fixed and also administrative cost that is fixed.
Fixed. Yes.
Moreover, company has excess capacity also.
Okay.
Recently, table manufacturer issued an offer from corporation to supply tabletops to table manufacturer. Table manufacturer considered buying the tabletops instead of manufacturing them internally. Which one of the following statements is correct? Yeah. See, company, we don't have an idea about the excess capacity here, but these two costs are something which is unavoidable, not avoidable. So
Yes.
opportunity cost of making the tabletops is zero because no production will be displaced.
Okay.
Because somehow they are saying that they have some idle capacity, but nothing has been mentioned in this.
They are saying buying the tabletop instead of manufacturing.
No.
Clearly, they are.
No. Table manufacturer is considering buying the tabletops instead of manufacturing them internally. We don't know the capacity of this company, right?
Yes, sir. They have not given.
Yeah, so the company has excess capacity. Yeah, that is there in the option. The option says table manufacturer should accept the offer if it is less than 47 and the table manufacturer has excess manufacturing capacity. Yes, if the company has excess manufacturing capacity, that is what they're saying, right? They have
Yes.
excess manufacturing capacity as per the option.
Yes.
So if they have excess manufacturing capacity, what they will do?
They only take relevant cost.
Yeah, for them opportunity cost is zero because they will be making that, isn't it?
Yeah,
So
they
if they
are
have excess
making the
they will be utilizing their excess capacity instead of giving it to someone else, correct?
right.
So what we are considering is if they manufacture, let's say, if they manufacture, the only relevant cost what they're going to incur is 47. That's what only they're going to say the other person, the other company who is offering them to give them at this cost, correct or wrong?
Yes.
So they have idle capacity. They can use this idle capacity to make these tabletops. So why will they give this task? Why will they again give this task to someone else?
No,
So
they
to
will
give it to
giving
someone else, what offer they should get? The table manufacturer should accept the offer if it is less than,
47.
yeah, 47 they are incurring to make,
Yeah. If they
and
are
they have
getting
idle
instead,
capacity also. If someone is
yes.
giving them less than 47 offer, they will go for it. Finished.
Yes. Yes. Okay. Got it.
Yeah, next one.
In
First is they can easily manufacture. They need not give it to someone else. And next, other party should give them less
husband.
than 47. They'll go for it.
Yes.
In insourcing versus outsourcing decision, the decision process favors the use of total costs rather than unit costs. The reason is that irrelevant costs may be included in the unit amounts, correct?
Irrelevant cost.
See, irrelevant cost may be included in the unit amounts.
Yes. But irrelevant is not included, no, sir. Only we'll take relevant cost.
Yeah, see, the decision process favors the use of total costs rather than unit costs. Yeah, we have always taken the total cost only, right?
Yes.
But in that we have like, you know, excluded fixed cost, correct?
Yes. Fixed cost is irrelevant.
Unit irrelevant cost may be included in the unit amounts. Unit cost may be calculated based on different volumes. Unit cost, yeah, see, we will be having unit cost also, and we'll be having total cost also, correct?
Yes.
So
Per
here
unit and
also,
total.
yeah, here also we are saying that this is the unit cost, this is the total
Mm.
unit cost, correct?
Yes. Yes, sir.
This is the unit costs. So for making one unit, this is the total unit cost.
Right.
So in outsourcing versus insourcing, the decision process favors the use of total cost rather than unit costs. That means one of the questions we saw total cost also, total cost
Yes.
rather
Mm.
than per unit cost.
Yes. Unit total.
Okay, this I will just explain afterwards something, okay?
Okay.
Because I need to give you some example for this. So Samreen, we will take up this in the next class. How many questions? We kind of 11, right?
Yeah.
One question we left. 11
We
we
left
attempted. 10, yeah, 10
mm,
we attempted.
10.
So how many are there in this? 35.
Some 42 or
No, 35.
35. Okay.
So if it is 35, we need to do how many questions? 17, right? 18 questions, correct?
Yes.
So 10 we have attempted. 8 more questions we will do. No worries. So next class in this week, I will definitely take one class and finish this make or buy.
Okay. Sir.
Either I will take by tomorrow or day after tomorrow. Any of these 2 days, I will definitely take.
Mm.
And these doubts also I will clarify. And
Okay,
then
sir.
this and this is leftover, right? Decision
Yes.
making
Okay.
cell
Mm.
as is or process and keep or drop. Okay.
Yes, sir. Too.
Yeah, by this weekend we'll close this. Okay.
Okay, sir. Okay.
Yeah. Thank you so much.
Thank you.
Thank you.